The biggest banking advantage is not a higher balance, it is lower friction. While the poor often pay just to hold money, the wealthy are rewarded for keeping money inside the system. Today, we are auditing the invisible tiered structure of banking to show how the rules quietly change as your net worth climbs. If money feels harder to manage the less of it you have, that is not random. It is structural, and it starts with how banks price friction into everyday financial behavior. We are breaking this into three parts. First, why low balances attract the highest penalties. Second, how credit access changes your margin for error. Third, the exact moment banks stop treating you like a risk and start treating you like a client. Most people miss this completely. Banks do not reward loyalty, they reward liquidity. That misunderstanding traps people in systems that become more expensive the less money they have, even when they try to do everything right. Let's audit what I call the low balance tax. Someone has $400 in a checking account. The bank charges a $15 monthly maintenance fee. That removes nearly 4% of their liquid cash every month. Over a year, this becomes a serious drain on someone already operating with thin margin. It is not just a fee. It is a compounding disadvantage that reduces stability over time, especially when income is inconsistent or unpredictable. Now, compare that to someone with $250,000 at the same bank. Fees disappear. They get a dedicated banker, better loan rates, higher transfer limits, faster service, and sometimes premium perks. The pattern is consistent. The less money you have, the more expensive the system becomes. The more liquidity you have, the smoother and cheaper everything feels. Same institution, completely different experience based entirely on your balance. Banks view small accounts as overhead. Too many support requests, too little profit, too much risk. But large accounts are assets worth protecting. So the bank absorbs costs to retain those clients. This is the hidden threshold. Below it, friction compounds. Above it, friction disappears. Banks are not designed to create equality. They are designed to maximize profitable relationships, and your experience changes the moment you cross that internal line. Rule 1. Low wealth levels pay the highest friction. The trap is the slow bleed of small fees, maintenance charges, overdraft penalties, ATM fees, late fees, transfer costs. Each one looks harmless in isolation, which is why people ignore them, but together they create a constant financial drag. When your margin is already thin, these small leaks reduce stability and increase the likelihood of future penalties. These fees do more than reduce money. They reduce stability. One bad week can trigger multiple penalties. An overdraft leads to another. A missed payment creates interest and late fees together. This is how people enter the fee cycle. The system compounds against instability, making recovery harder the longer it continues. It is not just spending. It is a structural feedback loop that punishes low liquidity. The fix is to remove maintenance friction completely. Use fee-free accounts or low-cost alternatives. Audit every account you have. If you constantly struggle to maintain minimum balances, close the account. Do not stay out of habit. Banks are not loyal to you. Treat them the same way. Removing recurring fees is one of the fastest ways to stabilize your financial system without increasing income. Rule 2. Credit access defines your margin for error. The trap is using high-interest debt as your emergency plan. A car repair, medical bill, or sudden expense becomes credit card debt. This feels normal because it is common, but high-interest borrowing destroys flexibility. It locks future income into interest payments and reduces your ability to recover from financial shocks. Debt feels normal because it is normalized. Minimum payments seem manageable. High interest rates feel acceptable because everyone carries balances. But the real cost is flexibility. Every dollar spent on interest is a dollar that cannot build liquidity. That is why credit structure matters more than people realize. It determines whether an emergency becomes temporary stress or long-term damage. The fix is to treat credit as a liquidity tool, not a lifestyle tool. Credit should buy time, not fund consumption. Wealthy individuals protect credit access because it gives them optionality during stress. The same emergency produces different outcomes depending on the structure behind it. One person stabilizes, another enters a long-term debt cycle. Rule 3. Wealth buys negotiation power. The trap is accepting financial terms as fixed. Most people treat rates like rules. The bank says a number, and they sign. But institutions compete for profitable clients. Many financial products have flexibility built into pricing. The problem is not that better terms do not exist, it is that most people never ask. The fix is to behave like a client with leverage. Always request competing offers. Always negotiate. Even small percentage improvements create large long-term savings. Wealthy individuals understand that percentages control systems. That is why they audit rates, not just payments. The smallest changes often produce the biggest outcomes over time. Rule 4 begins with a mistake: confusing visible assets with liquidity. Many people appear wealthy but operate with fragile cash flow. Expensive purchases create the illusion of stability, but banks evaluate accessible cash, not appearances. Liquidity is what determines flexibility, not status signals. Liquidity buys time, negotiation, power, and control. It prevents forced decisions and allows better outcomes during stress. Over time, it also changes how institutions categorize you. The more liquidity you maintain, the more stable you appear in the system. That perception changes your access to services and opportunities. The fix is to build a liquidity floor. This is a level of cash you never drop below. Not investments or retirement accounts, but accessible money. Automate contributions into this account. Systems outperform willpower. Even small, consistent transfers create meaningful stability over time. Rule 5. Banks reward leverage, not loyalty. The trap is staying with institutions that extract value from you. Many people remain with the same bank for years, earning almost nothing on their savings. Familiarity creates comfort, but also inefficiency. The fix is to manage your money like an auditor, not a fan. Move capital where it is treated best. Compare rates regularly. High-yield accounts often outperform traditional ones significantly. Small improvements compound into meaningful gains over time. Here is the deeper truth. Financial fragility makes every mistake costly. One overdraft or missed bill matters. That pressure forces short-term thinking. But liquidity expands your time horizon. It allows calm decisions and better outcomes. The difference is not intelligence, it is margin. Banks understand this dynamic. The system profits from instability. But when you build liquidity, everything changes. You gain time, flexibility, and negotiating power. The real power of money is not consumption. It is reduced urgency. The final insight is simple. Wealthy people are treated better because banks need them. When you have little money, you generate fees. When you have liquidity, you become a relationship worth protecting. That is the inversion most people never see. Stop trying to be the perfect loyal customer. Build enough leverage that institutions must compete for you. That is when friction disappears and the system starts working in your favor instead of against you. This week, audit your last 3 months of banking activity. Identify every fee, every charge, every unnecessary cost. Then consolidate fragmented balances into a stronger liquidity structure. Small, scattered money creates friction. Strong liquidity creates leverage. There is a threshold where the system stops charging you for instability and starts rewarding you for liquidity. Most people try to reach it without realizing what changes. The goal is not appearance, it is control. What is one financial rule you think changes once someone becomes wealthy? Think about the everyday differences you have noticed in banking or credit. The answer usually reveals more than expected.